Good evening, everyone. Greg McDermott with Cyber Trading University, welcoming you to our free options FBC. This one, Delta and the Black-Scholes model. We're going to take a new approach here. We're going to try to get more focused and specific on our topics for our FBCs. Kind of give you a little bit of a peek into the classes that we teach, phase 1, phase 2, phase 3 of our options, sort of giving you a little piece of what we do in those classes so you can kind of see if it's something that might help you in your trading. We're going to might go a little bit shorter than the normal hour tonight when we're just taking this, Delta is going to be the focus of our discussion, but we are also going to, I'm going to go over the Black-Scholes model at a very high level and give you some of the other pieces that you get along with the Black-Scholes model. Let's get moving right to it. First, the risk disclaimer. Everybody take a moment and read that. And then on to about Cyber Trading University. CTU has been an educational trading institution since 1995. CTU established itself as a leader, first by working directly with the SOES trading firms, teaching them to day trade. Cyber Trading University was one of the first to establish itself as a quality stock market trading school. Each instructor, including myself, has a minimum of 6 years of actual trading experience before they begin to work with students. And over the past 14 years, we've taught thousands of students to be successful and profitable traders. Finally, CTU headquarters located in the heart of the trading world in New York. My slide, Gregory McDermott. I earned my Master's of Applied Finance from Macquarie University in Sydney, Australia. Earned a Bachelor of Science in Financial Management from St. Joseph's University. I was a crude oil options trader at the Merc, the New York Mercantile Exchange. I was the head options market maker for JAS Securities at the Philadelphia Stock Exchange. While there, I managed the firm's portfolio risk for our team of 10 options floor traders. Was a market maker in the Dell computer crowd at the Philex. And back in the day, Dell was the busiest equity option traded in the United States. I directed an all-floor trading unit for JAS Securities and qualified as a DTR at the International Security Exchange, the ICE, the ISE, while I was off-floor. So enough about me. Let's get some information. And let's talk about the Black-Scholes model. You may or may not be familiar with the model, but it was the first model used to determine or to quantify, I guess would be a better way to put it, the value of an option. In fact, originally, when options first started trading, they only traded calls. There weren't even puts. But the Black-Scholes model was developed by Fisher Black and Myron Scholes, first laid out in their 1973 paper, The Pricing of Options and Corporate Liabilities. Originally determined, used as a way to hedge options using a ratio of the underlying security, that concept we are going to talk about coming up. Now, since the Black-Scholes model was rolled out 40-plus years ago, there have been many iterations and improvements to that original model. There were a lot of things that were limiting, first of all, just simply the computing power available in 1973 versus today. Clearly, everyone on this call, if they have a smartphone, probably has more computing power in their smartphone than Fisher Black and Myron Scholes had at their disposal to try to develop the Black-Scholes model. I talked to you, there were a couple of assumptions that built into this model that have since been modified. They assumed a European exercise. What's a European exercise? It means that the options in the model cannot be exercised early. They can only be exercised at expiration. Now, every equity option traded in the United States is an American exercise, which allows for exercise at any point. So this wouldn't be valid today. Also, the idea that the risk-free rate and the volatility remain constant. Well, in the world we live in today, it feels like the risk-free rate would be constant. We've looked at, when was it? December of 2008 was the last time the prime rate changed. It's been at 3.25, I think, since December of 2008. So it has felt like that. But volatility, clearly not a constant. Moves intraday and intraday and can move significantly. So again, a limitation of the model. Stocks pay no dividends. Clearly not the truth, not the way that all equities trade. Markets are efficient. No snickering, please. That's what we could see. That's one of the assumptions that, we could argue whether markets are efficient or not, but that's probably a discussion for another day and maybe another FBC. Since then, we've obviously gotten models that have taken the initial idea of the Black-Scholes model and improved upon it. You'll hear of things, the binary models and the Bjergen-Stensland models, and there's all kinds of models out there, private ones, public ones, that can give you options pricing. Now, relax. Everybody take a deep breath. There will not be a quiz at the end of this. So trust me, we don't need to know what the math for the call and the put are. But what I did want to point out, a couple of things. That as complicated as that looks, and again, those of you who didn't do well in math in high school, just take a breath, relax, we're fine. But if you look at the components that go into the model, at least at its simplest form, the cumulative distribution function, the standard deviation, normal distribution, okay? A little complicated. Time to maturity. We know how many days there are between now and any point in the future. Relatively simple. The spot price of the underlying asset. We know what the current price of the option of the stock in this case would be. We know what the strike price is. Again, we've already established that the risk-free rate is probably relatively simple and constant. And then volatility. So really, the biggest piece of this is the volatility piece, which changes, as I said, intra and inter-day. So the large portion of this model is relatively straightforward. So again, no quiz on this, but what the Black-Scholes model and subsequent options pricing models will give us are the options Greeks, broken into a number. There's a number of different Greeks. What are the Greeks? They are measures that come off of this valuation of a call or a put. And when we talk about the options Greeks, I'm going to talk about them at a very high level. When we go into our classes, we dig in deep. So we're going to go quickly through these, pausing and stopping and digging very deep on delta. But I want to make you aware that there are a couple of different features and Greeks that come out of this Black-Scholes model and quickly let you identify them. Let me take a moment. It looks like there's a I'll check the questions before we go any further. We don't have any questions. Okay, good. We're good to go. One of the options measures is vega. What is vega? It's the measure of the effect of the change of volatility on the price of an option. We mentioned that that's sort of the wild card piece. That's where the pricing of options moves from somewhere between science and art. Again, most of those other functions, inputs into the model are well known and clearly defined. Volatility is the tough one. And the thing you want to think about with volatility, again, we're talking about the measure. What happens to the value of an option, all things equal, if volatility moves up, we call it a click, moves up 1. What percentage movement should you see if you are long or you are short? How should that impact the pricing of your option? It also, to be noted, can be a cumulative measure of risk in a portfolio. So if you have, like when I was a market maker on the floor, I might have a Dell Computer position, and that position could be made up of calls, puts, front month, back month, leaps, long, short, and volatility was a measure that you could aggregate to come up with a general risk in the portfolio. Now, it usually is more helpful when you're talking about vega to aggregate them by month, because you can get more movement as you get closer to expiration. So if you have a portfolio, for example, that let's just say has long vega, so that means you're the owner of options owner of volatility in the front month, but you are short Vega in the back month. You may aggregate those numbers and come up with a zero. The plus and the minus equals out, and you may incorrectly think, wow, I'm hedged, I'm flat, I have no risk. And it would not necessarily be true, because the movement between months can be unequal. So if you are long the front month and short the out months, and volatility gets crushed, normally that front month would go lower more quickly and be more susceptible to that movement than a back month. That's why you'll hear people tell you, other people who teach about options like to talk about doing calendar spreads. And although calendar spreads do have a time and a place that you can use them, one of the inherent, maybe unknown risks in that is the divergence of the volatility. You're long February, short March, or your short February, long March. You may have the same strike, you may have the same long 10, short 10, but there's a volatility component there that puts risk in that position. And that's like one of the things we would talk about when we do our phase 2, phase 3 kind of classes. So volatility measured, and we call it Vega to talk about that measurement. Theta, it's the measure of the effect of the passage of time on an option's price. Options, all things equal, are worth less tomorrow than they are today. Why? Tomorrow is one day closer to expiration. Think about the milk. The milk in your refrigerator is one day closer to spoiling tomorrow than it is today. So the kids better start, drink their milk to get it taken care of. It's that same idea. Options go to expiration. So when you talk about time decay, it's always negative. You lose value. Now that doesn't necessarily mean that it's always a negative for your position, because if you are short options and all things equal, they lose value, that is a positive for your position. So how it impacts your position depends on whether you are long options or short options, but the general concept of time decay falls back to the idea of something like the sands through the hourglass. It's always going. The clock's always ticking, and it's one of the components that comes out of the Black-Scholes model. You can measure theta, or time decay. And as with volatility, you can aggregate that risk, but you have to recognize that if you're trying to balance month over month, in general, the front months will decay more quickly because they are closer to expiration than the back months. When I say the back months, I mean the ones farther out. So we sit here today, and it's January, and pardon me, it's January. I'm losing what's left of my mind. It's February. February would be our front month. The out months would be, say, July or August or September or January of next year. Those are going to have less daily impact of theta. So the time decay component will be less for farther out months than they will be in the front. So theta measures that in your position. It can measure a single option or an aggregated portfolio of options. Rho. Rho is not a girl you went to high school with who didn't like being called Rosemary. Rho is the Greek measure that we use for interest rate movement. Now, as I noted, prime rate hasn't moved since, it's been 6.5 years since the prime rate has moved. Doesn't mean that it can't move. And owning options or being short options puts your position at a measured risk to the movement, because we saw it's part of the model, although not normally as impactful. We measure the rate of change in your options value, your exposure to the movement in rate in the underlying options, movement in interest rate on your option. So this usually is a relatively small impact on your day-to-day portfolio. Most rate movements are deliberate, so I'm not saying you can always anticipate them, and you do have to worry about the exposure in your position. The thing that it will do, though, is it's a little more uniform in its exposure, in its impact to your position because the interest rate trades across the board, and it's uniformly changed. So that, again, it's not a huge consideration, but it is one of the things that we go into, in more detail when we talk about options in our Phase 2 and Phase 3 classes. Now, we're going to get into delta because that's really the meat of what we want to talk about tonight. And we're going to talk about deltas of calls, deltas of puts. We're going to define in the money, at the money, out of the money characteristics, and we're going to talk about it. So let's think about delta is, let me see if I have it on the, well, let's do it this way. There's the standard definition people like to use, and there are three kind of ways to look at delta, the way I look at it. Delta is the rate of change in the price of the option based upon the movement of your underlying. So if you have a delta, just quickly, of, let's say, 50, we're going to go through this a little bit more in detail, it would mean that, in general, if your underlying moves up $1, the price of your underlying calls should move up 50 cents, 50 versus 100. You can either, and we talk about it here, you can either refer to deltas in whole numbers. Usually that's what people do. And a delta can be anywhere from 0 to 100. And when you have the delta of calls, there's deltas for calls and deltas for puts. When you have a delta of a call, it's always a positive delta when you buy it. And you talk about being long deltas or long calls, whereas deltas for puts are negative or short. So if you are long puts, you have short deltas. Your bias or your profit is targeted for a downward movement. And we use delta to describe options. I'm sure you've all heard the terminology, and I have it there. It's an in-the-money option, an at-the-money option, and out-of-the-money option. Well, delta is the defining piece that gives us the category of in-the-money, at-the-money, or out-of-the-money. Not surprisingly, an at-the-money option is an option where the price of the underlying closely corresponds to the price of the option strike. So, for example, if, make sure everybody's broadcasting. I got a little message here. My internet might not be that great. An at-the-money option, if you have a $100 option and the underlying is trading at 99.5 to 100.5, around $100, normally we would refer to that as an at-the-money option. And correspondingly, depending on how much time until expiration, and we'll talk about that momentarily, the delta for that option would be about 50, depending on time and those sort of things. An out-of-the-money option would be an option where in the calls, the strike of the call would be above the current stock price. So in our example, stock's trading around 100, 110 call would be out of the money. An in-the-money call would mean it has some intrinsic and extrinsic value. That would be one where the strike price is below the current stock price for calls. It's the exact opposite for puts, and we're going to go into that in a minute. So in our example, a $90 strike with the underlying trading at 100 means that the in-the-money option would be the 90 strike as an example. And one of the things you need to know is that the absolute value, because calls are positive and puts are negative, the absolute value of the call and the put on the same line in the same month must equal 100. So you know that if you've got an 80 delta call, you must have approximately a 20 delta put. If you have a 45 delta call, you should have about a 55 delta put. I could go through a lot more examples. They would all take two numbers that would add up to 100. I'm sure you all get the idea. Let me check for some questions. Good. Everybody's good? So let's take a look. This is from our friends at Thinkorswim. just before anyone gets too crazy, I do want to point out that this is the balance in my paper trading account, not my real account. That's a $53 million paper trading account. That is not my regular account. Oh, how I wish it were. But this is a screenshot from Apple 2 days ago, 3 days ago, a couple days ago, recently. And you'll notice that when you look at, you can set your stock screens up. I'm going to go to a pen here to try to Valentine's Day, we'll go to a red pen. So what you'll notice here is here's our, sorry, thought it picked the pen for me. Here's our underlying. It's Apple up there on the left. It's the February expiration. And here we have delta, gamma, which we'll talk about in a moment, theta, vega, and then the bid-ask spread, and these are our calls. And then the puts are over here, and we have the same thing, delta, gamma, vega, theta. Now again, we call delta the rate of change. So a couple of the things I pointed out, just so we kind of are clear. The underlying is trading at, let's call it 119. 118.93 was the price here. So we're going to call this strike, the 119 strike, our at-the-money strike. What did I tell you about that? The delta for the call should be about 50 if you're at the money, which should mean the delta for the put should be about, again, absolute value, about 50. If we go down to say let's go down here to the 113s that are $6 in the money. Our delta here is 83, which should mean our delta here, again, rounding error, 16, 17, approximately the same. And what else do we notice? We talked about theta, the time decay. What's this tell us here? This tells us that right here, the at-the-monies are going to lose approximately 8 cents each day in decay based on the days to expiration and their at-the-money, in the money. You'll notice that the at-the-monies are higher, the out-of-the-monies are a bit lower, and you see approximately the same on the calls and on the puts, although you'll notice the puts theoretically are decaying a little penny more here, not significant. So they're about the same. And you'll also notice that the volatility numbers correspond. So the 119's calls and the 119 puts, about 9 cents. What's that tell us? That tells us that if volatility goes up by 1 click, the value of the calls and the puts should go up by approximately 9 cents. Now, again, you can aggregate this for an exposure, or you can try to figure out the change in value. Honestly, what I used to have to do, again, I sound like my father, so I apologize, but 20 plus years ago on the trading floor, the computing power we had was very limited, and I used to literally I would print sheets at home. We didn't have a computer in the office on the floor at the Philex, and I would print sheets up, and if volatility changed, you'd have to physically use your paper sheets and be able to say, okay, vol's up 5 clicks, so now I have to reprice my options 45 cents higher approximately based on this number in your head, or make a note and then know when you're bidding and your sheets say you should be bidding 215 for a call. Now you know fair value is 45 cents higher, 260. What's your bid? I'm 250 bid at 70. So that's when we had to use it. Now, again, computers make it a little bit easier, but the idea is still exactly the same. And you can get all of this information from Thinkorswim really, really easily. And if you look at gamma, we're going to talk about that at the end after we discuss delta more. You've got all this information sitting right here, and when you buy or sell options with Thinkorswim, you look at your position, and it will give you your net, gamma, delta, vega, theta. You'll give you all of your Greeks laid out for you. If it's one option, it's relatively simple. If you have a couple of options, in fact, if you've joined us in Cyber Group, And if you're here from Cyber Group, welcome. Glad to have you here. It's nice to be able to talk to you for a little longer than the few minutes I get every day. We aggregate and we look at that. Are we long? Are we short? And part of it has to do with, particularly with delta, maybe trying to get a little bit neutral in our positions. So let me check. I think I'm going to get rid of my pen. Let's clear the drawings. Looks like a kindergarten kid trying to connect the dots there the way I draw, and I apologize for that. Okay. Do you buy call or put based on which Greeks you want to play, or do you mostly trade based off the delta? There's Tracy. Glad to hear from you. I don't necessarily do a trade because in and of itself, because of the gamma or unless the trade is, and there's ways to trade, it's called gamma trading, where then you specifically look for undervalued options that have a high gamma, where the underlying is trading more actively than the gamma, where you can buy it cheap. But in general, I look at where do I think the underlying is going to go based on charts or whatever service you use. Then you go into the options and then try to determine where can I get my best value. Delta is usually the bigger concern because you're trying to see how much of the movement of the underlying can I capture with this option based on balancing things like the theta or the decay. And again, people say, oh, well, geez, why wouldn't you just buy options? Because that's great. Well, yes, buying them's good, but sometimes you have to, they can be expensive and they decay quickly. So what we'll do, and Tracy, you've seen me do this, is we'll look to do spreads, usually vertical spreads, which will allow you to, if you're buying some delta but you've got some decay, sell another option where you can sort of balance out and mitigate the impact of something like decay. Yes, there's a recording. It's per contract when we talk about decay. And Grant's on board, so we are on a roll here, guys. Let's keep going. So I told you earlier, there's a lot of ways, but I want to talk about 3 ways to look at delta. It's the most common of the Greeks. It's the one used most often. One of the ways to look at it is simply, noted it earlier, the rate of change in your option's price. So if the underlying moves $1 and you have an 80 delta option, you should get approximately an 80-cent move in the underlying. So that's a pretty clear, simple understanding, sort of a predictive. Now, how do you use that information? Tracy just asked a question that leads you to that answer, which is when you're trading, you're balancing how much does it cost me versus how much am I going to participate in the movement if I'm right, or more importantly, if I'm wrong? So one of the common mistakes people will make, particularly when you're trying to trade in earnings or an event, is people will look at the absolute dollar value and say, geez, I want to buy inexpensive options. Usually those options are out of the money options. What's that mean? We'll talk about it in a moment, like we'll write out an example, but in general, that means that the strike for the option, the call in this case, or even a put out of the money, the strike price, the point at which you need the underlying to trade above for a call, below for a put, is usually away from where it's currently trading. So that if you have, for example, you buy the 110 calls in a stock's trading at 100. Well, the delta on those 110 calls might be about 30. Well, the underlying could move up $5, and your option might only move up $1 or so. So you were right in direction, but you didn't participate because your delta was low. But you had less money at risk. If you had bought a 90 delta option, you would have participated more in that upside move, but in totality, you had more at risk. So that's what we're talking about here, where it tells you how much your underlying moves. And here's that example I was talking about. So when it moves, if you have a 90 delta call, and again, holding my breath because this thing is jumping like crazy. I have no idea why, so I'm going to just go back to my regular pointer. For some reason, this thing will not let me draw in. Let me try the pen one more time. I have a question. I'll check the question. Yeah, the delta will tell you that, Tracy. So let me see one more time. I don't know why this thing is being so finicky. So here's my example. The underlying stock is trading at 100. If you own the 90 delta call, and these are all just ballpark examples. If you own the 90 delta call, the 90 strike, and it's currently trading at $11, and it's got an 80 delta, stock moves up $1, our stock price should be approximately $11.80. If it moves down $1, our stock price should be approximately $10.20. That's a $1 move up in the stock. Our 100 calls are at the money, 50 delta, goes up $1, we take it to $5.50, goes down $4.50. The out of the money calls, the 110s, they're only a 20 delta, so it moves up $1 and it only goes to $2.20, or it goes down to $1.80. And the other thing you need to think about when trading in this example would be you're balancing. Tracy asked it earlier. You're also balancing. Theoretically, you've got $11 at risk on the 90s. You have $5 at risk, and you only have $2 at risk in the out of the monies. Now, the return merits the risk, again, as an example. So this is one of the ways to look at delta. How much is my option going to change in price, up or down, when the underlying moves? What percentage of that movement will I be able to capture? So it's the rate of change of the option. The rate of change of the price, to be specific. So now let's move to the other one. And this is what the original Black-Scholes model brought for us. With the Black-Scholes model, they were trying to come up with a way to let a trader know, let's say it was traders, because that's most often who use this. This is what I used to use it for. How can I hedge my position? And what is a hedge? Well, it's a way to, in one way, mitigate the risk in a position. Another way to look at it is a way to try to capture perceived fair value. Let me talk about that one first. As a trader on the floor, I'm making up a number. If I was trading in Dell, someone came in and wanted to buy some calls. They wanted to buy 10 calls. And theoretically on my sheets, based on my model and whatever, let's say I thought fair value was, $2.10. And they were looking to sell it. And they're saying, what's your market? And we would bid, I'll tell you how long ago it was. We would have bid in eighths and quarters. But let's just say we made the market 2 to a quarter. We think they're worth 10 cents. And the trader comes in and says, the broker comes in and says, sell you 10 at 2. So now I've bought options for $2 that I theoretically believe are worth $2.10. One of the ways to try to lock in, and again, there is no locking in. You don't take the ticket up to the front, to the desk at the options exchange and get your cash. But if that were, say, a 50 delta option and I bought 10 of them, so 10 of them is the equivalent to 1,000 shares of stock. My hedge ratio is 50% because it's a 50 delta option. I would sell 500 shares of stock, 50% of 1,000. I would sell 500 shares of stock against the purchase of those 10 calls in an attempt to lock in and hedge, lock in the profit of approximately 10 cents, and then hedge the risk, putting me at a position that we would call delta neutral. Delta neutral means delta can also be thought of as like equaling stock. So if someone says, oh, I'm long 1,000 deltas, they're really saying they're using it interchangeably with I'm long 1,000 shares of stock. How would you hedge being long 1,000 shares of stock? With options, you would then go out and sell real stock of the underlying, say 1,000 shares, and then you're delta neutral. So you would, as a market maker, you would go back and forth. Now, you don't have to hedge your position, but in an attempt to get an equivalent stock position, you use delta as a way to measure that risk. If you look at the stock and you feel like you're long 1,000 deltas, you then end up selling 1,000 shares of stock if you want to fully hedge it. You don't have to. You could ride with an effectively equivalent 1,000 share long position. I mean, I traded so long ago that when we used to trade, like I said, I had sheets of paper and it was the old open outcry. I had tickets in my pocket from the trades I would do. And if you didn't have time to go literally leave the crowd to go input them into your crude computer system, I can remember grabbing the tickets out of my pocket and sort of just ballparking it and figuring, it feels like it's about 2,000 deltas long. And I would just yell to my guy, sell 2,000 del if I wanted to hedge the trade. So that's the other way you can think of delta is it's the hedge ratio for an individual options trade or for a portfolio of options. Long and short, you can aggregate the delta based on the current price and come up with a number that will, in theory, from a stock or delta standpoint, get you delta neutral. And what does that do? In theory, that mitigates your risk for movement of the underlying. Now, it's at that particular moment and that particular price. As the stock underneath moves, your deltas are dynamic. Why? Well, partly because of a thing called gamma, which we're going to talk about at the end. But they move up and they move down, depending on whether you're long or you're short. So it's never like you just walk away. The only way to walk away from a position is to just square it up and sell it out. You're long a call, those 10 calls I bought, the only way to walk away from that is to sell the 10 you bought out at a profit or a loss, take them off and have zero. As long as you own options or are short options, there are a balancing act of risks, all derived from the Black-Scholes model and mostly measured, most of the risk can be measured clearly and cleanly by the Greeks that we've talked about. Each sort of a give and a take. If you're collecting premium, you're collecting theta, you're short options, and every day the options lose value, you're in theory making theta. But if your underlying hedges cost you more money than you make, it can be a bad position. So there is no correct answer like, oh, you should always be long gamma, you should always be long delta, you should always be short delta, long theta, short theta. It's all an analysis at any one time. How do you want to do it? And that's what we talk about when we're talking about taking the information. My goal when we talk about phase 1, phase 2, and phase 3 is really to get you from being someone who may understand options and trade options to someone who's an options trader. And there's a difference. I look at things differently than most people do when it comes to trading. First thing I want to find out is, where's my risk? What's my downside? That's what I want to know. And then is there enough profit, possible upside, to take on the trade? So this is the second way to look at delta, which is simply that hedging ratio. How can I lock in or mitigate my risk to the underlying movement of stock by taking a de facto stock position and hedging it with real stock? How do I know the measure? And so you understand that when the deltas change and they get towards 100, the underlying options move. Let's say if you get a delta that's effectively 100. Well, you then have an option that's going to move almost exactly like stock. So if you buy 10 calls and it's a 100 delta, when you sell 1,000 shares of stock against it, you've mitigated most of the risk. Now, it's not all of the risk, and that's a discussion for a different day, but in theory, you've hedged the delta risk at that moment. And when you look at this is a look at the way if you were long options, long gamma, how the deltas can move. Let me just see. Pardon me. They move up, and it becomes a stock equivalent. And if they move down, it's also a stock equivalent. The red one in this example shows us long gamma, where when it goes down, we get short, which allows us to buy some underlying. We have a net short position from our options. How do we hedge that? We hedge that with stock, a purchase, to balance the possible, the downside, the negative, the short position, the downside bias position we have in our options. And the third way to look at it, and it's not a perfect measure, but as a trader with lots of things going on, you find you want to come up with sort of ballpark, quick measures that you can use while lots of things are going on. One of the classic examples is trying to figure out, going back to volatility, how do you determine, with volatility being quoting in an annualized fashion, normally, what's the annualized volatility, and what's that mean? It's the annualized move you would expect in the underlying stock. Well, okay, that's my annualized number, but how much would I expect my options to move in a day if my annualized volatility is this or that? And there's an old school trader trick where you would divide the annualized volatility by 15. So if the annualized volatility was 30, you would assume that the underlying should move about 2%. Well, why did you use 15, Greg? Well, when you're doing the detailed calculation of volatility, it has to do with the square root of the number of trading days that you're using. In a year, there's 250 trading days, which is, and again, it's the square root, is pretty close to 225 trading days, which is the square root of 225 is 15. So that's one of those shortcuts we use. Well, one of the other ways to use it, one of the other shortcuts we used on the floor was delta is a de facto predictor of the chance an option will finish in the money. What's an in-the-money option? It's an option whose strike price for a call is below the current trading price. So if a stock is trading at 100, for example, the 90 strike is an in-the-money call. And correspondingly, the 90 put is out of the money. On the put side, the 110 put, because it's higher than the current trading price of 100, is an in-the-money put. The corresponding 110 call would be an out-of-the-money call. So you can use the delta to give you a ballpark of the chances that the option's going to finish in the money. Now here's a look at, again, our friendly neighborhood Thinkorswim. And you can see that they can give you the probability that it will finish. Let's see if this thing will let me grab the pen. He says hopefully. Here's the probability in the money. Now you can also drop that down and make it probability out of the money. But I prefer to think of it on the positive. It's a glass half full, glass half empty. So approximately, now again, if the delta is 86, it's an 85.06. Again, close enough for government work. 70% delta, 67.72. It's ballpark. When you get closer to, at the money, it's relatively close. I'm not telling you it's a perfect measure, but it's at least in the neighborhood. And if you look at it here, delta's 13, about a 14%. It's going to be in the money. Delta's 43, it's 44.7. Delta's 87, it's about an 88%. Again, it's not a perfect measure, but these sort of things that I developed as a floor trader, because there's, again, when I used to do it originally, computers were a luxury that not many people had, and you had to have ways to be able to understand and process lots of information. This is not a perfect analysis of the probability that an option is going to finish in the money, and it doesn't tell you clearly by how much. And for you, you do have to figure, geez, is it going to be, if I own the call, is it going to be a nickel in the money or $5 in the money? That's another factor we're not considering here. So just as a sort of insider trader trick, it's about equivalent. I'm not telling you it is. It's just an about. It gives you an idea of what are the chances by expiration that this option is going to finish in the money. Check the questions. Somebody was talking, said, had a put last week, the underlying dropped, but the put didn't move at all. That's probably because we had an out-of-the-money put with a low delta. And again, or it could have been a volatility issue. One of the other pieces is a lot of people trading earnings recently, you'll find out. We had a trade on in the cyber group in Priceline, I think. No, not Priceline. It was, geez, I'm getting old. Regions, maybe. One of them, we had a condor on, 2 vertical spreads. And the day before, volatility was pumped up. Day after, the underlying went one way, but volatility just came crashing in, and that can also impact the price of your option. Again, there are a lot of pieces moving to come up with the price of an option. Here's a quick look at if you have higher or lower volatility options, just sort of a graph, and how that impacts. Here is our delta on the left side. Our strikes run along the bottom. And you'll see that, and this goes to that question that may have just been asked. If we look at, I don't know why this is doing this, but I'm going to have to get rid of that. I don't want to mess this thing up. So if you look at the 50, let's say the 55 strike, with a low volatility, that delta is about 11, but with a high volatility, 29, a considerably higher delta. Now, again, as we get closer to expiration, and that's coming up in a moment, these sort of go to polar opposites. So this just shows you that the price of volatility can and does impact the deltas for a particular option. And if we look at this one, again, it's sort of the same idea that we've got low volatility and high volatility impacted. This is the put version of what we're looking at. This is the 65 put down to the 40 put with the 50 in the middle. You have the same sort of higher vol gives us higher deltas, lower vol, relatively lower deltas. And this shows us the effect of time on delta. Again, 50 at the money. When we're at the 40 strike, everything's about 99 or so, 1 year, 6 months, or 3 months. But as you get closer to at the money or in the money or out of the money for calls, the delta drops. Why does the delta drop on the 60 call from a 1 year to a 3 months? Why does it go from 25 delta? Let's see if I can make this. Why does it go from 25 delta to 3 delta? Well, because the 3 delta, there's only 3 months to be right. Out here, there's more time, which positively impacts the deltas. So that's for the calls. And let's see. And there it is, same thing on the puts, the same idea. And this is, I do want to touch on this. They call this Trumpification. Obviously, this has nothing to do with Donald Trump, but it does have to do with the fact that this could look a bit like a trumpet, my poorly drawn attempt at that. And what does this tell us? That as options approach expiration, they tend to move towards the extremes of 100 and 0. Because they either become in the money or out of the money. There are less options. When we're back here with 100 days or 360 days to expiration, we tend to stay around the average or the midpoint. And then as we get less and less time, it's more and more likely that an option in the money stays in the money, an option that's out of the money, out of the money. And at expiration, options either have a 0 delta or 100. So we tend towards that, whether it be calls or puts. The deltas move to the extreme towards either 100 or 0 at expiration. Let me check if we have any questions. There can be a correlation between price movement and volatility. It's Vega is just that factor. Does it say that there's a 28% Apple will move plus or minus $5? Let me go back. So do you prefer buying calls when you want vol to decline? No. If we buy calls and volatility declines, we lose value. The value of the options decrease. For Tracy, let me go back to our example. Go back. The deltas are over here, Tracy, and what it's telling us is, for example, we should get about a 50-cent movement on our 119 calls if it moves $1. Separate but analyzed, they're figuring there's about a 48% chance that the stock's going to finish over this strike, which is 119. So a little less than a 50% chance, although our delta is at 50. So let me roll forward. And let's finish by talking about gamma. It's the last of the Greeks we're going to talk about. I saved it till after delta because, to the couple of the points that were just made, gamma is the rate of change, to make it sound all highfalutin, the rate of change of the rate of change. It's the rate of change of delta. It measures the velocity of the price change and the hedge ratio. So, in the example that I've given you, stocks trading at 100, the 90 calls are trading at $11. The delta is 80. If it goes up $1, I said the option would be worth $1.80. Well, the reality is the option would be worth more than $1.80 because gamma would affect how quickly the delta changes. So just like delta measures the rate of change of the price of the option when the underlying moves, gamma measures the rate of change of delta, or the rate of change of the rate of change. And it sort of spirals it up and spirals it down. So it sort of accelerates the movement to the upside when you own it, or the downside with the puts. So again, we will talk about this in phase 2 and phase 3 in a lot more detail. But again, it's derived from delta, which is why I saved it till after we talked about delta. I really appreciate everybody being with us tonight. I hope everybody liked the format of trying to take one topic, dig in really deep. I'm going to be running a phase 2 option at the end of the month, last couple days of the month, and I don't have the dates in front of me. Please reach out to your educational advisors. This is going to be a topic we're going to cover in phase 2. Phase 3, which follows it, goes into more detail about spreads and how you take this information and help yourself make good decisions, manage the risk in your portfolio, manage the risk in your trades, and become profitable. And that's really what we're here to do. So I appreciate everybody being here tonight. If you have any questions, please reach out to your educational advisors. They will be happy to help you. This is Greg McDermott for Cyber Trading University signing off. Thanks for joining us.